Hey everyone, Couch Investor back to another video for today. So let's have a look at stocks that are under $100. There is one that is a little bit above $100, but you'll excuse me when you know which company I'm talking about. Now, all four companies are yet to report their quarterly earnings, so keep that in mind. One of the four companies is a dividend paying company. I think if you're an older investor, you might have that dividend paying company in your portfolio as well. Shareholder yield of over 12%, so not too bad. Anyways, if you have other ideas for stocks under $100, let me know down in the comments below. And of course, just because it's under $100 does not make this company, does not make this stock cheap. Valuation wise, could be very expensive, could also be very cheap. So let's start with company number one, very popular company out there, and that's PayPal. PayPal is still trading under $100, it's actually trading at around $73. So let's have a quick recap and look at their guidance for their next quarterly earnings, which should be out in a couple of weeks or so. So Q1 highlights was this. So revenue wise, they're not growing as fast as before, non-GAAP year-over-year change of 10%. But if you look at operating income, that increased 19% year over year, and EPS increased 33%. Of course, with PayPal, we know we're still waiting to hear who the new CEO will be. I think that will be a great catalyst, if it's a good CEO, of course, for this stock. Now, since Q1 was such a good quarter, they say here we are confident in our momentum and are raising the full year EPS guidance as a result. And so if we scroll down to the guidance for Q2, they expect net revenue to grow approximately 7% or so. If we look at full year guidance, they see here a growth of more than 20% when you look at earnings per diluted share, which is not bad at all with a forward PE of 14.2 times. I mean, could be more expensive in my opinion, especially if we reaccelerate the growth there. But overall, if we look at the analyst estimates for sales, we expect even more growth going into 2024. So fiscal year 2023, 7.5% growth there. Fiscal year 2024, close to 9%. And then fiscal year 2025, 8.63% growth there. When you look at EPS, there's even more growth. So the company becomes more profitable, should help with free cash flow as well, because the company is buying back shares, which is also why you can see that its shareholder yield is 3.14%. Now, of course, with interest rates close to peaking and the expectations of a rate cut, or at least a pause for the second half of the year, things should become much better for fintech companies such as PayPal. And I mean, for those that think that PayPal is a dead company, nobody uses its product anymore. I mean, the numbers don't lie. We've covered this countless times on this channel. And there is more growth towards the unbranded checkout, which is Braintree, which of course, yes, right now has lower margins, but should improve in the future. So first company, first stock under $100, I think PayPal does the trick. Now, second company, and this is the dividend paying company, and yes, this might be a bit controversial for some of you, but it is Altria, ticker symbol MO. Now, with regards to Altria, of course, if you look at the valuation, forward PE of 9.1 times, so not very expensive. But if you look at the growth rates when it comes to EPS, again, we can see more reacceleration for fiscal year 2024. If you look at fiscal year 2023, expected growth here is 2.76%, but fiscal year 2024 and 2025 is closer to 5%. And like I said, if you look at the shareholder yield, you can see it sits at 12.70% with a dividend yield of 8.25%, buyback yield of 1.53%, and debt paydown yield of 3.01%. So let's do the math here for the long-term dividend investors. Let's say you invest $1,000 in Altria for 10 years at this shareholder yield of, let's take 12%. Your $1,000 become $3,000. Pretty good return, right? Now, let's say you are young and you're really looking towards building a dividend paying portfolio. So you're looking out 30 years from now. Your $1,000 will be worth $30,000 30 years from now. And that's without adding any additional money throughout the years. That's pretty good returns in my opinion. Now, of course, you might come with a rebuttal here and saying, yeah, okay, fine, they have a nice dividend right now, but growth is slowing down. The popularity of smoking cigarettes is coming down, which is true, but it is being replaced with something else. Monthly e-cigarette sales rose by nearly 50% during first 2 years of pandemic, and this is according to the CDC. Researchers say the sales were primarily driven by fruit and candy flavors, which is why we're seeing companies like Altria, British Tobacco Company, Philip Morris, they're all going into that market as well, already in that market actually. Now, of course, Altria already tried something with the acquisition of Juul, which was a complete disaster. But more recently, they announced that they completed the acquisition of Enjoy Holdings, which will help them in the e-vapor market. And full disclosure, I own Altria, BTI, and Verizon in my very, very small dividend paying portfolio that I'm trying to build out over time. I will never take cash out of those positions. Every dividend is being reinvested to buy more shares, and so the snowball becomes bigger and bigger. I'm always looking to add more and more companies into that portfolio, but right now I do think that such a high yield of 8% you rarely come across a lot of times. Now, if you enjoyed this type of videos so far, leave it a thumbs up, subscribe if you have not, would really appreciate that. And if you would like to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now let's talk about the company that is not under $100, but is not far away from it either, and that's AMD. AMD is now trading at around $110 or so. We'll report earnings on August 1st, which of course we are going to cover on this channel. Yes, it isn't cheap. It's trading at 34.8 times forward PE. But here again, for fiscal year 2023, yes, we've seen already the Q1 results, right? Which, to be honest, weren't that great, right? This is non-GAAP year-over-year revenue, gross profit, gross margin. I mean, they were all down. Earnings per share was down 47%. So Q1 was not really such a great quarter. If we look, revenue, $5.35 billion. Now, if we look at Outlook, we can see that they expect revenue to be basically flat quarter over quarter, and it will be a decrease of 19% year over year. Gross margin will still be 50%. Of course, all eyes will be on the data center segment. Revenue there was flat last quarter, and operating income actually plummeted to $148 million from $427 million. They say this happened because of the product mix and increased R&D investment. Now, of course, with the AI hype around NVIDIA, you expect AMD to take a little bit of market share in the data center segment, most likely from Intel. Talking about taking market share, apparently AMD's global server CPU market share tops 25% according to Lisa Su. So there's already one positive. Now, of course, AMD's growth, just like NVIDIA's growth, relies a lot on TSMC. And we know that TSMC has some delays when it comes to the Arizona plans. And they also reduced their own guidance for this year. And then we got this headline here: AMD will consider other partner foundries to TSMC. Now, it would be very, very funny if they choose Intel, which, to be honest, I don't think they will, because they're really direct competitors, but wouldn't surprise me if they go with Global Foundries or even Samsung for that matter. Now, going back to the valuation, like I said, forward PE of 34.8 times, not cheap at all. By the way, this is on Koifin. I recently interviewed the co-founder and CEO. Video will be in the top right corner, and link is down in the description if you want to support this channel and you can help yourself out as well. So, forward PE, expensive, but if you look at the reacceleration of growth when it comes to EPS for fiscal year 2024, the estimates for that, we can see close to 50% growth there, and then another 25% growth in 2025. So, to be honest, if we're seeing this dip actually under $100, I don't know, maybe Intel will report pretty good earnings, which will mean they are taking back market share, which could lead to this stock dropping. And then AMD reports earning and they have great guidance, just like we've seen with NVIDIA the last quarter. This stock could jump back up. Let's wait and see. I expect a very, very volatile earnings season. But all in all, with AMD, even though the stock is up 70% this year, I think all the hype has been around one semiconductor company, which was Nvidia, and AMD has been left behind a little bit. Now, let's move over to the last stock, which is under $100, and that is yet again another fintech player, which has been performing a little bit better since I mentioned it as a buy for the month of June and July, I believe, and that's Block. So Block has a market cap of $46.35 billion. Forward PE in this case doesn't really make much sense because, as we've seen, net income there, EPS is very, very volatile, goes up one quarter, goes down the other quarter. Not really something I'm looking at right now. Gross profit has been going up for Cash App and for Square quite nicely for the last couple of years. So that's one metric I will keep my eyes on in the next earnings report, which should be pretty soon, August 3rd. And here, again, the market expects EPS even for this year to already grow 70% year over year. Fiscal year 2024, 38%. Fiscal year 2025, 32%, 0.69, which again, you can't really find that many companies where the expectations for EPS growth are so high, especially not for a company like Block, which has been underperforming for quite a while. If you look at sales, fiscal year 2023, 18% growth there, fiscal year 24, 13.6, and then fiscal year 2025, 14.61. And the same thing here as with PayPal, as we're reaching peak interest rates and expected it to get reduced in the second half of the year, but certainly in 2024, this becomes a tailwind for a company like Square. Spending becomes a bit easier as well, and they should definitely gain from that. Now, there are still many aspects of the business that I do want to see become much better, such as the underlying business, the profitability of the business. I would like to see a bit more consistency when it comes to net income, when it comes to free cash flow of that business. But seeing the underperformance of this stock, I did have to put it yet again in one of my lists. Of course, there are many other companies that I could have put in that list. I mean, some of you might put Shopify in there, even though Shopify is trading at a very, very high multiple. Same with the Trade Desk. Great companies, but very, very expensive currently. So that will be it for this video. Of course, do share your 4 companies or even more down in the comments below. Which are you most excited about for their earnings report? Let me know down in the comments below. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not. See you all in the next one. Bye-bye.